Good morning, Lothar. Thank you for joining me on this sunny morning. Not what the markets are maybe reflecting at the moment, but that's why we're going to have a quick Q&A. If that's good with you.
Yes, absolutely. Good morning.
Morning. Excellent. So I suppose let's hit the ground running in terms of where are we at the moment? What's gone on and what have we seen?
Well, we've hit another one of those patches of utmost uncertainty, although this time around it is very much geared around a person and the policy. So it is, if you like, comparable to what we had over the last couple of years in terms of a a growth scare, i.e. markets being unsure about where the journey is going to go from here, whether the economy is going to be fine or not, and selling off. What's exacerbating it in an unfortunate way is that it's all self-inflicted, because it was all going quite well until the Trump administration decided that somehow the US needed to be better off than they already are, and started the trade war. And the uncertainty stems from the fact that it's been very much a stop-start sort of environment, where you seemingly can never really rely on anything that's being released. Just since last week, however, markets are starting to wonder whether they need to assume that the Trump administration is actually hell-bent on doing this, regardless of what it might cause to their own economy, to their own people. And so the markets are feeling very abandoned in a way and very insecure about the future, which has led to a sell-off which started. Well, it had been ongoing for a little while since the peak of the markets in late February, but it really kicked off after that Liberation Day, as he called it, where he presented reality TV style his plans for the future. And they accelerated really into what we saw on Friday and also today, what we call capitulation levels, which we've last seen during the pandemic, just before the lockdowns, when all of a sudden it's not just equities which are selling off on concerns about future growth and profits. All of a sudden you're seeing gold and government bonds sell off as well, which tells you there's now a liquidity squeeze going on, i.e. there are now people in the market who need to sell things to cover obligations elsewhere, called margin calls. If they have gone into the markets on a leverage basis, for example, then there is forced selling, and that forced selling then just accelerates everything, and you plunge further down until, and there always are, otherwise markets wouldn't clear, there are people who are saying, well, actually now the market has overshot, and start buying again. And there were different points already over the last couple of days when you thought that had happened, but then, for example, China came in with retaliatory tariffs, and all of a sudden everybody started thinking, oh dear, if this just gets worse and worse and worse, what happens then? The difficulty, I suppose, in this situation is that so many things, as we wrote in the Tatton Weekly last Friday, can just change very quickly, and therefore you don't want to be caught out on the wrong side of this. So just imagine he meaning Donald Trump, steps out in a day or two and goes, oh, we've had tremendous success with what we announced last week. Everybody is crawling at our feet and begging for some better, to improve their trade deals. And so we've decided to suspend this whole tariff thing for 3 months to see where we get to in negotiations. And then, markets would be jumping up in no time. And therefore, it is very, very ill-advised at the moment, dare I say, to move too rapidly.
Yeah, absolutely. I suppose even for the shorter term investor, i.e. those that have only been invested for a few years, if they've experienced the COVID pandemic pull down that we had, then more recently we had the Russian invasion into Ukraine, and we saw markets come off there. Those two events certainly highlighted the benefit of not making any knee-jerk reactions and being calm and hopefully letting things move forward. So I suppose that touches on your point there, Lothar, that, you know, perhaps for investors, it's important to keep on to the long-term objectives and try and I know it's not easy, and investors all around the world will be in this position where you've got to try and drown out that noise that we're experiencing at the moment. But you're absolutely right. It will only take a potential tweet, a social media post, or an announcement in the Rose Garden there in the White House for things to change very rapidly. So for an investor, does this create any opportunities? How are perhaps Tatton and maybe other investment managers are on the ground adjusting portfolios, or are you staying steadfast and trying to let things blow over?
Well, at the moment, we are not moving too much because I always say if you're starting to move hectically in very busy traffic, the chances of getting run over are much higher. We did, through the overlay fund, move to an equity underweight, bond overweight, and this was now 3-4 weeks ago, underweighting US equities. That was a move that is beneficial. Obviously, in the overall scheme of things, it doesn't look like it's going to turn the dial that much. We can't and won't move people away from the risk profile that they sign up for, but that's what we can do. And whenever you've got periods of volatility, there's also then sometimes a mispricing of individual parts of the market. So our underlying active fund managers are certainly quite busy picking up bargains, as they would call it, or as Warren Buffett in the past has always says, and I like to quote it all the time, whether it's socks or stocks, I like to buy when things are on a discount. So, for people who have perhaps waited with deploying cash because they felt that the markets were a bit elevated, well, starting to feed it in is now probably not a bad thing, because you can now buy at prices that we last had a year ago.
Yeah, absolutely. And to touch on another point there about bonds, if we saw central banks reduce rates as a preemptive strike, how might that change things?
Well, generally, we have to say that compared to years past, we are now at yield levels, interest rates levels, where central banks can do something. They have got firepower, and therefore eventually, if the Trump administration isn't going to move very quickly, you will have some emergency meeting somewhere, because central banks' job is to provide liquidity in the markets, no matter how much they like or dislike the policy that's being pursued. It's just their mandate. The other thing is, with bond yields being at more normal level, as we all remembered from before the financial crisis 15 years ago, they also do react as a counterweight to the equity markets. So we have this time around seen that diversification benefit coming from bonds, which have, at least until last week, did rise quite nicely when equities were going down. So there was a balancing, and it was really the highest risk portfolios which will have gone down the furthest, whereas those that have more bonds than equities have fared a lot better.
Yeah, absolutely. And in terms of the outlook, then, I know you don't have a crystal ball because we'd all be on that sunny beach together. Where do you see this going in terms of the short term? How long do you think we're going to see these, big bouts of pullback and volatility in the market?
Well, it may well carry on for a while, at least this week. We have seen European markets open a lot lower initially. By this time at the moment, they have seemingly found a bit of a bottom, but it's still down 5% from last Friday, which isn't a great starting point. But it is, as we said early on, that there will eventually investors be coming in who are seeing this as a bargain, and who have a different view as to how long the political side will carry on with sticking it out, and at what point in time the pressure from falling surveys and from falling opinion polls, get really to the politicians and saying, you know what, we've pretty achieved what we wanted to achieve. Let's roll back. And now, when that precisely happens, I don't know. And markets could fall, another 10-15% from here. That is entirely possible. I'd certainly be a buyer at that point, but don't take that as advice. Because at the end of the day, the world isn't ending because of this. The US is potentially impairing itself, and we might, or in due course, have to make some asset allocation decisions in portfolios as to where we spread investors' money. But the global economy is going to continue to tick along and run from here. And let's not forget, it entered this period in a pretty solid and resilient position when you just think how it really went through interest rate rises from 0 to 5% without actually falling in that much expected recession. It didn't happen. So we can also summarize that the global economy has been and is relatively resilient, and therefore it's not that likely to say, right, from this vantage point onwards, we're going to hit a global recession or worse.
Yeah, I was going to touch on that next in terms of the risk of global recession. I suppose that risk factor is dialed up now based on what we've seen. And how much could this be a deliberate attempt by Trump to increase those fears? Because there's a lot of talk at the moment that the US has got an incredible amount of debt coming up that needs refinancing. I think around $9 trillion. Does this play into his hands when he's maybe trying to reduce costs for the US government potentially? I know that's been, widely spoken about.
Yes, there's a lot of these sort of conspiracy theories going around, but I'm afraid it's not quite as 3D or 4D chess as some people might want to suggest. At the end of the day, he needs a supportive electorate for him to continue with his policies. He's not a dictator, neither will he be in the near future, and therefore, if he causes a significant recession or downturn in the US, he's going to lose all the public support apart from the 20 or 25% MAGA people who don't have anything to lose, really, I suspect. And therefore, that is a very unlikely strategy to be pursuing. And indeed, at the moment, it would help them a lot more if the dollar was strengthening, not weakening, because with the tariffs that they have imposed, their expectation somehow from some academic theory was that the dollar would strengthen and therefore would equalize the price rises that happened through the tariffs, and therefore the US consumer wouldn't be really hit with higher prices. It's all not going to plan at the moment, and the end game, yes, the end game was that the dollar's value would be lower, but not at the beginning, and so this is not actually panning out as they had planned it.
Good point, Lothar, particularly with the dollar weakening as much as it has. Yeah, it sort of goes against that theory, doesn't it? Last question then. Do you think this marks the end of globalization?
No. I mean, there have been, over history, always attempts to turn back history and reverse things. I do not think and do not believe that you can do that. Particularly, I mean, let's face it, the US these days is no longer a third or 50% of global trade. Global trade is about 13%, 1-3, between the US and its outside part. It has already been a relatively isolated or sheltered economy, if you like, compared to other economies. It is possible that the US goes into more protectionism, and that wouldn't be good for the US. But I have a good belief in the strength of the US society. Disregard and underestimate the power of the US at your own peril was what I've learned over the last 30 years of being in investment management. That doesn't mean that I'm dogmatically, a eternal friend of the US economy and the US market. We will move in whatever way we have to, but don't jump to rash conclusions at the moment as to what may happen over the medium term. At some point, the U.S. Senate and the Republicans there will probably come under enough pressure to pass that pressure on. The president is not a king or emperor in that sense, not a dictator that can do whatever they like.
But yeah, I suppose the flip side of this, we may see other trading partnerships strengthen on the back of it, particularly around Europe and in Asia. They may look to forge new relationships on the back of this.
And that was what initially drove the stock markets in Europe and Asia into a different direction than the US. It's only been for the last 10 trading days, more or less, that they have moved in parallel. But if we look at year to date, a diversified portfolio will have benefited from the fact that that we'll have investments everywhere in the world. And it was because those countries, those nations, very quickly decided that they needed to become less dependent on the US and opened the fiscal floodgates, if you like, in areas which were not very expected, like in Germany, where they are overstepping their very long form principles of debt management. And they have got deeper pockets at the moment than the Anglo-Saxon world because they didn't borrow quite as much as we have historically, and therefore they've got a lot more firepower. And we know that China has had a domestic demand deficiency for a number of years now, and they really seem to get the head around. And also because they were the target of Trump 1.0 tariffs, they really have, in the meantime, become more used, if you like, or have more of an idea of how to react to it than all the friends and trading partners of old who have, now need to react rather more quickly. So yes, there is a lot of policy activity, and in a way, perhaps with hindsight in a year or two, we may say this was the point that actually galvanized a lot of leaders who had always quite lazily just relied on the US to bail them out, be that through the demand of their forever hungry consumers or with the military power that they had. And this may indeed lead to a more balancing world, even though the change and the upheaval that it causes at the beginning is unpleasant.
Yeah, no, good observation. I suppose we saw, we witnessed the beginning of that with Germany increasing their defence spending massively. It could open the door to new opportunities. Brilliant.
Indeed.
Thank you very much, Lothar. It's great to catch up. I'm sure you're going to have a busy week ahead as we are speaking to investment managers and just providing as much context and information as clients need, because that's what we all humbly serve as our clients, to make sure that they understand
Absolutely.
what's going on.
One last point that I would leave with you and your clients is what I always say is very easy to turn into cash. It's much, much harder to then decide when you're feeling confident enough to go back into your long-term investment strategy. So history has shown that it's just so much wiser to stick with the plan and see it through rather than trying to time the market. So time in the market rather than timing the market has again and again been the more winning, the better winning strategy.
A great pearl to leave us with. Thank you, Lothar. Speak soon.
Thank you very much. Take care. Bye.